So welcome to the Independent Solutions Wealth Management quarterly update call. My name is Drew Miller, and I'm head of advisory consulting and business development. And with me today is Chief Investment Officer Dan Neiman. Dan, welcome.
Thanks, Drew. Glad to be here with you in Buffalo.
Absolutely. It's great to be here. So Dan, halfway through the year, the markets continue to show resilience in the face of stubborn inflation, continued interest rate hikes, and the fear of a recession. What are your thoughts for the second quarter, and how do you see us positioned going forward?
Well, you've got the S&P 500 up about 16%, the NASDAQ up 32%, the Dow only up about 4%, by the end of June. And, I think the resilience you're talking about is a lot of shift from growth or from value to growth at the end of 2022. We had a pretty bad year last year from the growth sector. And what do portfolio managers do? They're trying to shift their profits into something they think will go up. And that's really what I think has happened over the past 6 months. And I think over the next 6 months, we're going to see maybe a shift back. And so you'll see maybe some profits being taken on the growth side, some of that money shift to value, because at the end of the day, I think the markets, they follow a pattern at some point, and you're going to see value start to maybe pick up the slack a little bit, and then growth will be taken down a little bit.
And talk a little bit more, you mentioned the strong performance, especially looking at the S&P and NASDAQ, but talk about how that S&P specifically, that performance is somewhat misleading. We talk about the Magnificent Seven, and clients I don't think truly understand when they're trying to look at what they're currently holding versus what say the S&P has done.
Yeah, you say Magnificent Seven. A few years back, it was the FANG stocks, right? So whenever something's going up, you got the media drawing attention to those stocks, and a lot of people don't want to miss the ride. 7 stocks in the S&P 500 outweigh almost every other stock. And same true with the NASDAQ, but yet only one of those stocks, Microsoft, is on the Dow. So the reason the Dow is lagging is mainly because it doesn't have 6 of the stocks that have gone up so much this year, mainly a few of those like NVIDIA. And, again, I think you're going to see some profit taking, some shifting. A lot of the ETFs have to weigh their assets to whatever index they're pegged to. That's a lot of institutional trading. And so you see a lot of people pushing all their chips, call them chips, into these 7 stocks. And at some point, they've got to rebalance their portfolio, or at some point, the indexes start to underperform and that money shifts out, and it shifts out fast. If you see a shift from growth or tech to value, what's going to happen? All of a sudden, other stocks are going to come up and be the Magnificent Eight, or whatever you want to call those next.
Right.
We saw a big shift out of energy, so Exxon and Chevron, big shift out of those at the start of the year. But now you start to see some stocks starting to come back.
Right.
And so, a stock like Costco didn't do so well towards the end of last year, but now it's flying again. You got some growth stocks that are doing really well. And so I think what we're going to see is, again, a shift, and then we'll see the media latch on. People will put their money where the media is saying to put their money, and we'll see that area grow. And we'll see the ebbs and flows of the market.
So let's turn now to John Thur, Chartered Financial Analyst and lead portfolio manager of the GARP strategy, Growth at a Reasonable Price, for his insight. So John, you just heard the questions that I posed to Dan. What are your thoughts on how we ended the second quarter and what we're looking at for the remainder of the year?
Well, Drew, that's what everybody's trying to figure out right now. And that's why I think the markets have capitulated to the new scenario that the economy's stronger than what everybody anticipated. So stocks have taken off. I don't have confirmation with earnings yet and sales. From the reports I'm seeing right now, sales are flat. Earnings seem a little better, but they're better than the downsized estimates. So it's misleading. So AI gave us a jump in November, and the market's been running with that. And there's been a handful of companies that have significantly outperformed the market. There's 7 companies that are very strong, but there's 50 of the S&P 500 have outperformed to the tune of about 26%. And then there's another 450 that have underperformed to the tune of about 5% in the first half so far. So it's not a real convincing market. And we've started to see some breadth widen out a little bit. But for it to be real, the stocks that are lagging have to catch up. And if I don't see those stocks catching up, I think we'll run out of gas with this, and it'll have been a nice rally, but we'll be giving some of it back.
A good point, and one to remind clients, when they're looking at that performance of the S&P 500, and how it, truly relates to their own individual accounts and holdings. But, talk a little bit about the GARP strategy and, kind of what you're seeing on the horizon for the rest of the year. Do you have any changes that you're intending to make? You talked about AI. Anything on the horizon with AI with respect to the strategy?
On the first part, I guess the best way to say it is I read an article by an interview of a well-known manager, and they asked his strategy and what's made him successful. And he frankly said, I go where people don't want to go. And when you're in a transition period, and this is a transition, we don't know how high interest rates are going to go, where they're going to end. We don't know if recession is still a possibility. We don't know if it's coming or not. With all those questions, we're in a transition, and this is a strategy I use in transition, is to try to find places that have value where people don't want to go. And I say that because a lot of people that invest are investing with computers, and they're using algorithmic models, and they're using software and factor investing to try to quantify their strategies and then hit a button and buy or hit a button and sell. And that creates momentum. But what I do is I go under the covers and I look for names that are forgotten or they're not the go-go names, and I go where nobody wants to go. So when you look at a company like Apple right now or Tesla, who doesn't own it? That wants it. Pretty much everybody owns it. They have to. A lot of the pension funds and the institutions have to own it, or they'll be fired. So they don't care what they pay for it. They just have to have it when the board meeting shows up. So my point there is, who's going to buy it next? But the stuff I like to buy is the stuff that nobody wants. So that when all of a sudden they looking around and they dig it up, or an article comes out or a good report comes out, nobody owns it. So everybody wants it. So that's kind of how I look at it, more of a flow of funds, supply and demand, go where people don't want to go and where there's a lot of buyers that will come later and drive the price up.
Yeah, it's interesting. You can have all the artificial intelligence in the world, but just to have that ability, like you said, to have that experience and to know where to go to look where, the computers and the programming and the algorithms may not. That's what really drives value, I think, and what makes you such a great addition to our investment committee and managing the strategy. So thank you very much for your insight today. Dan, a lot of those names that we were just talking about, are very much in the tech space, and that dealing with the AI conversation that everybody seems to want to talk about. All the talking heads on every media channel seem to want to talk about nothing but AI. Talk a little bit about what your thoughts are on AI with respect to the firm strategies, and are you looking to do any type of implementation around the AI space?
So AI is interesting. It's been around for a long time. I think since the first computer was invented, that was where AI started, which is now a long time ago. So, but it's the hot topic right now. Again, the Magnificent Seven, AI. Every company is going to go into artificial intelligence. Well, every company is already in there. It's just a question of how they're using it, how they're profiting from it, and how it helps investors like our clients or managers like ourselves manage companies that are in that space. I don't think it's going away anytime soon. I think if anything, it's going to help the bottom line. It's going to help corporate earnings. It's going to help efficiencies. Just like I told Glenn Wiggle the story where yesterday morning in San Diego Airport, there's a line for coffee, and I walk up to the kiosk and I hit the Americano that I want and the muffin that I want, and I got that before everybody else because I used AI. Right? I used technology to help me go faster, and it actually helped save them some employee time, so they got to help somebody else. So I think at the end of the day, it's an important topic. There must be nothing else to talk about in the news besides AI right now.
Right.
But something else will come up, and then that'll be the hot topic, and AI will take a backseat to something else. In the meantime, how do we profit from it? We use our intellectual capital at Independent Solutions, our portfolio managers, to look for opportunities in the market, just like we do with everything we're doing, and buy companies, buy stocks that we feel are participating in that movement towards more AI, I guess, not just AI. Because I think it's been around forever.
Right.
And I think that will an NVIDIA continue to soar because of AI? I don't know. Right. At some point, it's got to come back down to earth.
Yeah. Well, and talk about the firm strategies. How have we performed year to date? What are you looking at for the second half of the year and beyond?
Well, interesting. The strategic asset allocation models that we run are really sort of that core portfolio management holding. And we have stock portfolios. We have some blended models now we've rolled out. We're trying to roll out more models that can help us capture different asset classes or different types of strategies. But our bread and butter strategic asset allocation has underperformed a little bit this year, mainly because we stayed more heavily weighted towards value this year because last year helped us. So we have a little bit more heavily weight towards value, not a lot, but a little bit. And that I think has helped or has not helped our performance keep up with the risk and return ratio that we're looking for in those models. We're in the process of doing a rebalance right now and shifting a little bit back towards growth, although maybe a little late to the game. We hope that will help us continue to participate on the upside and protect on the downside. Obviously not going fully into growth. We still have our value percentages, but I think that making a more even balance of those will help us. If you look at the 3-year numbers of say our balance or our conservative or our aggressive models, they're keeping up with the risk of those and return ratio of those models. So if a client wants to be 100% risk, they should be 100% in the S&P 500, right? 100% in the market. But if they want to be a 65 risk, say capture 65% of that, we're doing a pretty good job of keeping up with that in our balance model, which is a 65-35 model. And we're doing a good job, I think, of rebalancing those portfolios. Like I said, we're rebalancing right now in middle of July. We haven't done a rebalance in 6 months. And so we're doing a rebalance now, and we're taking some profits off the growth side and putting those to work in value. And at the same time, shifting some of the holdings and some of the other and the percentages of the holdings that we have to try to capitalize on what's going to happen or what we think is going to happen, in the future. So if you look at the 3-year number on, say, the S&P 500, it's up about 12%. Our balance model is up about 6%, 7%. So it's close enough to what we feel the return should be for that model on a 3-year basis. Now, in the last 3 years, we've had an up and down market.
Right.
If you look at a longer stretch, we're obviously going to continue to try to stay with that number of 65, 70% of what the S&P 500 is doing.
Right.
Yeah.
So Dan, you talked a little bit about the strategic asset allocation models, and that was some great insight. But you also are the lead portfolio manager on our dividend paying models, and so talk a little bit about any opportunities you're seeing in the value space. You talked about everything shifting towards growth. What are you seeing in the value space, and especially for those advisors and clients that have assets in the dividend models? What are you telling them now?
Well, in some of the dividend models that I run, like the Neiman Large Cap Core model, for example, or the covered call model, they're actually doing quite well because they're a lot more concentrated in specific stocks that I think are going to do well over a long stretch of time. Whereas the Neiman Select 20, a little bit different approach. It's really focused on yield, and yield keeps going up because prices of those stocks have gone down. And I'm looking to do things like rebalance. I'm looking at finding opportunities for stocks that maybe cut their dividend during COVID or lower their dividend because of the inflation pressure or increased wages, and now are starting to ramp up their dividends again because they're able to earn more. And the approach I'm taking is really taking that portfolio management approach of rebalancing, seeing some opportunities in energy stocks. They've been brought down. I've seen some opportunities in retail stocks. I've seen other opportunities in sort of my bread and butter stocks that have constantly been in dividend portfolios for a long time, and just trying to invest the cash that clients are putting in, invest cash that's been paid out via dividends, and hopefully buy down on some of these value stocks that have been underperforming. And that will lift performance, as there is a shift from growth to value. Right. And even look at some of the growth stocks that are out there and say, hey, if they're paying a dividend and I want to participate a little bit on that upside, now might be a time to continue to ride that roller coaster up. Right. in a little piece of those portfolios. So when it comes to, obviously managing asset allocation models, it's a little bit different approach than looking at individual stocks. And the approach I like to take with individual stocks is, I don't know which stock's going to go up or down tomorrow. I feel like there's almost a 50-50 chance, but I have a good idea that a lot of the stocks in my portfolio are going to do well. And so if 18 of the 20 stocks go up, I'm doing good.
Right.
And if 2 go down, well, I can sell them. We're not married. I think all the managers at Independent Solutions, we're not married to particular stocks. We have our darlings. We have our ones that we like, but we don't have, we don't have the emotional tie. And that's kind of where I think hiring a manager to manage portfolios, we can take the emotions out of the equation a lot of the times, and whereas a client or even a rep can't.
Right.
And that's where we can really differentiate ourselves from the other firms out there, because we're not married to any particular stock or any particular mutual fund or any particular ETF.
We really appreciate your time and insight. For those advisors on the call, again, thank you very much for tuning in. And if you have any questions about the strategies, need help with anything, please feel free to reach out. And we appreciate your business, and we look forward to seeing you on the next quarterly update call. Thank you.